I'm 92.90, 10 by 10. Yours.
Mine.
99 at the book. Welcome to the OpenYield Markets Podcast with your host, Mark Hebert.
All right, welcome everybody to another episode of OpenYield Markets with Mark podcast. I am thrilled today to have Kevin Lynyak on the cast for a couple of reasons. One, he is a bounty of wisdom from his years of experience in the fixed income markets. And two, he was my first boss in trading. So Kevin actually hired me. I was in a junior sales role, and he hired me to be a trader back in 2007 at Morgan Stanley. So he was my first leader and mentor, and was a great coach. So today we have the Vince Lombardi of Credit on the podcast. Kevin is a Notre Dame alumni, currently getting actually an executive MBA at Yale. He has had various leadership roles in IG credit and fixed income over the years at Morgan Stanley, and I'll let him opine about those a little bit more in a minute here. But we are thrilled to have Kevin Lynyak on the show. So Kev, for those of for the audience that's listening out there, if you want to just walk us through a little bit about your career history, what you're doing now, and we'll take it from there.
Thanks, Mark. Thrilled to be here, I think. We'll see what you ask me. But I just hit on LinkedIn. I got a couple people hitting me this morning saying a little congratulations on being at Morgan Stanley for 21 years.
That's great.
Which is, I kind of forgot about that. It's done a lot of different things, which has kind of been interesting. So these days I'm at Parametric, which is a subsidiary of Morgan Stanley Investment Management. And we'll kind of dive into that. But I spent 20 years, as a bond trader, credit default swaps, working with you and on the desk. We had a lot of fun back then.
Oh, sure did.
Earned a bunch of this gray hair doing the financial crisis, European debt crisis, all that fun stuff. Then I went over to manage a bunch of trading desks on the wealth management side, and dealt a lot with market structure. And that was, dealing a lot of odd lot trading, but also, working with algorithms, equity and fixed income. And then one of the market structure changes on the wealth management side, and you think of like Morgan Stanley bought Smith Barney, 2013. We bought the rest of it.
Yeah.
But in many ways, we had never really kind of integrated the old Dean Winter merger from the 90s.
Yeah.
So it was a lot of that was updating systems, processes, and kind of merging the institutional and the retail businesses together. But also, as the wealth side of things grew, Morgan Stanley internally didn't have a team that managed money for financial advisors on the fixed income side. They had a couple equity PMs and some famous ones you probably see on TV. So we created that business, and it was a separately managed accounts business. Is how we kind of set that up. It was really unique. I was the original seed money for it, but we grew that to $6.5 billion, and we moved over to MSIM in the immediate time, and then Morgan Stanley Investment Management bought Eaton Vance, who had one of the largest SMA managers out there. 2020.
2020, yeah.
Work from home era.
Yeah, the work from home era.
But we've been dealing with that integration the last couple of years, and that's how I ended up at Parametric. Parametric is one of the premier brands owned by Morgan Stanley Investment Management as part of Eaton Vance. On the equity side, it's a great tax loss harvesting and beta business, very well known, used by a lot of financial advisors. On the fixed income side, it's the old tabs business.
Yep.
And very, very much a muni business. So I think the tax alpha from that aspect of it, but also because they grew up really just focusing on advisor-led fixed income. It was really a lot done in the market structure place, especially within the muni market, but now also in credit, treasuries. But really working with odd lots, trying to maximize that space, having algorithms that found value there for portfolio construction and alpha in our portfolios, as well as tax loss harvesting. I think it's kind of one unique thing about Parametric equity and fixed income that we're known for.
Just for the, we have a lot of specialists who listen to this cast, but as our reach is growing, for the layman's terms, if you want to get a little bit more into what tax loss harvesting actually is, just for the average Joe.
Yeah, look, we had real low yields for a long time in credit. So if you own securities in a taxable account and you've got losses, you can essentially sell them. And in many ways, if you got a loss in Coke, you can do that by Pepsi, and do it many different times, or you can use ETFs to substitute for that. And it's a very popular way to get your tax basis lower on the equity side. We're all trying to pay less taxes, especially us folks who, live here in New York City or used to live here.
You might be paying more taxes.
For the likes of things, it looks like they're going up. Yeah.
But that's might be getting higher.
Yeah. It's kind of, I think that's going to be a theme in this country, and we could kind of break into that. It's why I think municipal bonds are an important part of people's retail portfolios.
Yeah.
But even if you're going to own munis in a taxable account, right? You don't own them in an IRA. You don't corporates, preferreds, or something like that, probably in a fixed income in an IRA. But if you bought securities before 2022, we had a very low interest rate environment for a long time. So chances are you probably have losses in those securities. Yeah, and even just selling like for like securities there, you harvest those losses. I mean, you can carry those over versus your equity portfolios or anything else. These are themes that are relatively newer in the fixed income side of things. But I think when we were on the institutional side years ago, we never discussed tax.
Honestly, not once.
Yeah,
and that I can think of. I don't think it ever even was part of a conversation.
Exactly. So for advisors, they're not CPAs, most of them, but for their clients and high net worth individuals, it's a really important part of the overall portfolio and alpha.
So the next question I have for you, the next topic I want to talk about is a little bit about technology, and you mentioned you spent a lot of time in market structure. And with SMAs and retail accounts, odd lot execution. In fact, a little known fact, before this whole odd lot execution roadmap started, back in about 2010, 2011, the pioneer that we have on the cast here actually brought me in an office and said, hey, I think odd lot trading is going to be the way to go. We should actually think about creating an odd lot desk. Basically, it was the formings of an algo back in the day. I didn't end up doing this role, but we actually started having a focus at Morgan Stanley as we were growing up on electronic trading for odd lots. So yeah, and I think Kevin was the first person to actually bring that up.
As my dad would say, all true pioneers have arrows in their back. Some of it, we had some fits and starts in that business. It took a while. Look, the credit markets,
time.
The credit markets have been opaque, and really it's not until, for Bob and all the, and the proliferation of these kind of, larger trades, and ETFs. But ETFs are a big part. Like you look at you go back a couple months ago, muni structure, and like all of a sudden the muni market, you can't really be short the muni market.
That's right.
ETF outflows had people buying 5% at par because all of a sudden, it just market structure broke down, for a couple days. If you blinked, you missed it.
That's right.
But that's, the ETF market structure too. I mean, we were back there doing some of those original creates with BGI back in the day. And, it's a big part of overall fixed income market structure these days.
So in your current role, looking at portfolio construction, SMAs, talking to FAs and retail advisors, how do you use, or how did the traders that work for you use automation, electronic trading? How has that changed over the last, let's just say 5-7 years?
Yeah, look, it's changed a little bit, and there's been a few more players that have come on.
Yeah.
I'm not going to talk about the competition here, but they are.
Yep.
And they've just taken market share and they increase. But we find liquidity in the credit markets pretty decent.
Yeah.
It's Mike Nappy's my trader who's been doing it for a long time. He's been in the space. You've known him for years.
Yeah, great guy.
And so he's very focused on the market structure, but using some of those kind of equity market structure type topics that we discuss, and we track all that data on what trades and what doesn't, and covers and all that kind of stuff. The average bid offer that we trade. In many cases, we'll code that into our trading capabilities so that that we're not printing at the wrong levels, or if we are, it kicks us out and in our trading systems. So to be a little bit more disciplined and have a little bit more of a algorithmic process to it, it helps out overall client execution, and it's using kind of the more equity terms from 10 years ago in credit now. Like credit can still be opaque, and you go through a difficult market. You can have liquidity issues as we saw in April, but for the most part, markets are fairly orderly.
I mean, think about it this way. You guys probably process thousands of trades a day now with 3 or 4 traders. 10, 15 years ago, that would have been a team of 10 to 20 or 30 or whatever.
Yeah,
it's the same workload.
This is why I got out. I did it for 20 years, but I think, we had a discussion about AI. Well, coming over here, I think that's going to continue to be a theme.
Yeah.
Like Jay Powell got a question on this the other day, at the FOMC presser. What is going to be the effect of AI? And we're all starting to use it. And
100%.
firms are starting, Morgan Stanley's got a big integration. Advisors are starting into the process. I think it's still been kind of slow to pick up at a lot of other bigger firms because, how do you keep your data protected?
Yeah.
But I'm using it in my process of my weekend process, my Sunday process of going through and learning everything. Now I'm dumping all this stuff into ChatGPT, spit me back a recap of that. All right, where do I go deeper on, and what do I need to actually read? And I don't have to walk around with all the newspapers.
So getting into a little bit more of the meat and the juice of the markets, and there's a lot to talk about right now. So before I get into, the macro and the Fed and some geopolitical stuff that's going on, I just want to talk more about what you're seeing fixed income landscape right now. Are there certain things that you're looking at that you find compelling? Is there part of the curve you find compelling, certain products that you're looking at that you're saying, okay, I think there's some alpha here that maybe I can outperform the index by X, Y, and Z?
Look, we're credit folks. Credit spreads are tight. That's nothing you don't know. But I think yields for advisors are the
90th
highest.
percentile.
Yeah, are the highest they've been in years.
Yes.
So it's certainly a big part of the conversation. I'd say our flows are not as robust as last year. Maybe because these rates have been around for a while, or just it's been kind of a crazy year. Whether it's politics or tariff policy or fiscal or I think debt and deficits. It's kind of a side hustle thing that we've created as well as I go around speaking to advisors about debt and deficits. It's been a concern for years.
Yeah.
It certainly was it didn't really get discussed in the political landscape last year. Because both parties had something to do with the debt and deficits that we were carrying in. But for advisors and clients, especially retired clients, thinking about the next generation and passing these debt and deficits down to them, it's a big concern.
Yeah.
So I think that might have something to do with slowing on some of the inflows. We're definitely seeing net inflows into fixed income, but it's from what I see, it's kind of a barbell that a lot of advisors have. They've got some high quality, and usually that's through munis, treasuries, or IG corporates.
Yeah.
And the yield part of the barbell, occasionally in taxable accounts, people love preferreds because you can get a QDI return of like over 8%. That's giving you an equity-like return without the vol.
Yep.
Private credit has been a big one that people talk about a lot because we haven't gone through a cycle with it. I think especially as I was, down speaking with advisors in the first quarter of this year, as things got a little bit more volatile, people are like, hey, what do you think about private credit? And you and I have been through a lot of cycles. And it's usually where we see problems, where we see the leverage, show up in any of these different cycles.
Yep.
There's not one sector. It's not like telecom or frackers or .com or 2008, mortgage type stuff, CDO squared. It's not one area, but that's certainly been an area that's taken in a lot of AUM, and a lot of advisors have it. I think, if you're a manager on Morgan Stanley's platform, you have to get due diligence. So we have all the best. I'm not really worried about their holdings there, but that would be an area if we really went through a recession that hasn't been tested yet.
I'm not making the assembly to what mortgage backs were back in the financial crisis, but it feels like you have spreads sitting at 85, 90 in the credit index in the investment grade market. Very, very similar to where we were in 06, 07. And you have this big swoon of assets now and money all pouring into private credit. Probably starting in really 22, 23, all that private credit's got to be underwater too, to a degree. What happens when
it's all par? What are you talking about?
Exactly. It's all in hold to maturity portfolios.
Yeah, cliff assets, as we talked about in private markets, and look, you see in the private equity markets, the big universities are trying to tap out. The Swenson model right now, if we're going to start taxing endowments at 21%,
that's right.
They got to sell liquid assets. We've seen this in different parts of our career. I say also, I took this phenomenal class with the full-time MBA students.
Yeah.
Taught by Jim Chanos.
Ah, yeah.
And it was the history of financial fraud.
Heard of him.
Yeah. He's a historian more than he's a hedge fund manager. Right?
Yeah.
It was just fantastic. But we go back to the South Sea bubble of 1720 and the Mississippi bubble and John Law and France in the 1720 and fiat money. And every different time you go through every one of these cycles, it starts with some sort of innovation. And all of a sudden the innovation, then capital comes out. And then there's where the fraud and the bezel happens and people are making money off of it. And then eventually the bubble pops and then, you find out who's not wearing a bathing suit as the tide goes out, as Buffett said. We've seen these different innovations. We talk about CDO squareds.
Yeah.
I mean, I remember the CDS desk back in 2001. They were doing trade confirms on the fax machine.
Yeah.
All right.
Yeah.
You go to 06, 07, we were doing hundreds of trades a day.
That's right.
With contracts that weren't standardized, weren't centrally cleared. I mean, that was financial innovation.
Yeah.
True
innovation, actually.
.com, securitization of mortgages, subprime. I mean, all of those were different innovations that just, got way out of hand.
Right.
I don't know what that innovation is that's out of hand today. The thing that scares me is that Chano says is he's like, I think we're in the all-time bull market for financial fraud. I'm like, I lived Enron.
Right.
I traded Enron. I traded Tyco. I traded WorldCom bonds.
Yeah.
And I'm like, you're saying now's worse. And okay, where? I think for him, it's the crypto markets, and I'm on the Bitcoin train. I'm now believe it. I'm not an owner, but there is a lot of other stuff out there in the altcoin, space that I don't. I mean, how do you value it? I mean, so I there's certainly a lot of that stuff kind of going on, but to think he says we're in the golden age of fraud right now. That kind of scares me. Where it is, I'm not sure.
You have a lot of cooks in the kitchen, and some of them probably aren't behaving the way that they should.
In a weird way, though, I don't think it's in the investor grade markets. I don't think it's in the high yield market, and it's the reason high yield trades so tight.
Let's talk about Uncle Jerome himself. You have the Fed right now, who's being very hesitant to lower rates. You have talk of tariffs. You have trade deals that have not been signed yet. So in my opinion, the Fed's put into this corner where they can't react yet because there's not enough data. And that's what they're saying. You have an administration who wants them to act now and act hastily, very vocally. What do you think we do into year end? Do you think there's no cuts? Do you think we cut once? Do you think we cut twice? Do you think we raise? Like, where do you think we are in the Fed? What's your outlook there?
Yeah, it's interesting. I think Powell's got a very defensible position. He cut rates last year. I think he'd probably continue to be cutting rates right now. We've got 2 rate cuts priced in for the year. The dot plot came out. It's got another 2 on there. It's interesting. Merrill Lynch and Morgan Stanley, their strategists have no rate cuts priced in for this year. I mean, the street's kind of all over the place on this, but it has been pushing it out.
Yeah.
Look, I mean, if you're an economist and you're at the Fed, they're all looking at their ISLM curves and trying to figure out is this inflationary? Should I be moving that curve up, or is it going to be demand? So their dual mandate, it's they're in a tough place with this.
That's right.
Look, I think we're starting to see some cracks in the economy. If you look at jobless claims picking up, I've seen the revisions to the monthly jobs data. I mean, they keep coming down. It's something that we usually see in a soft cycle. Now, we had a little bit of softness last summer and things picked back up. And I think Powell was pretty sanguine at 4.2% unemployment. They've got it going up to 4.5%. I mean, historically, that's been kind of fine.
Yep.
I just think there's so much uncertainty right now that it's really kind of hard to tell.
Now, the Fed's being patient enough where they can just say, hey, until we have real data, let's just not do anything. Right?
Look, the one thing, there's very few people out there saying that rates should be higher, or that, Jim Bianco has been one of them, saying we're justified. And look, and you could say neutral rate may be much higher, and being that, I mean, given everything that we've got right now, markets and the economy seem to be doing well. Atlanta Fed GDP now is 3.4 for the second quarter. It's better than I would have thought.
If you get 15% tariffs across the board, in my opinion, it's going to be very hard to get inflation down 2%. Stated goal. I think what will end up happening is
near term
fight this goal, and then eventually they'll say 2.5%. They will change the target goal, not Powell, but the next.
I just think the Fed will put me in the 2 rate cut camp for this year. I do think that the economy will start to feel tariffs, and they'll also, start to feel lack of immigration too. And so, I think eventually that'll hit the growth mandate. For me, we're going to be cutting. It's just when.
Yeah.
So I do think you want to have some high quality fixed income in your portfolio.
Yep.
For advisors, it's very interesting. Advisors don't buy long duration stuff. Maybe some buy TLT, but very few.
Why is it that they don't look out to duration? Is it, like you said, they're worried about the red ink? Do they just like the safety of the front end of the curve?
I think it's portfolio volatility. I
Okay.
think a lot of advisors think of fixed income as it's going to return to par, and it's a carry trade.
Yep.
Look, the total return aspect of it, I think, is an important part, and that's where duration comes in. But it's managing through the volatility in their overall portfolios. And in many years, a lot of advisors think of fixed income as ladders or muni bond ladders,
Yep.
and it's how they use them. I look at the preferred market. You look at what's popular there right now. The structures there's in the preferred market, there's really two types of structures. There's fixed for life, and those are usually in the 25 par retail market.
Yep.
And then there's the kind of the fixed to floating rate structure, the rate reset structure that has a long dated coupon, perpetual, but it's callable after 5 years, or it rate resets off the 5-year treasury.
Yep.
It used to be 3-month LIBOR, now we're using the 5-year. Since the duration's a lot lower on that, the volatility's been a lot lower. And I've just seen money going from one area to the other. And especially preferreds were very popular when fixed income was below 1% in the COVID years. And all of a sudden, they issued a whole bunch of preferreds with 4 handles. Some of those things I don't think we'll ever see par again.
Yeah.
So, in the 25 par market, a lot of that stuff trades in the 80s and can be fairly volatile due to the long duration on it. The other stuff that has current coupon between 6 and 7%, and a fixed to floating rate, it has better coupon, less volatility. That's where advisors want to be. And I look at an area, you talk about like what sectors we want to be in right now. Certainly people are thinking in active management, staying away from tariff related sectors.
Yep.
The biggest issues in the preferred market, and one of the growing areas, it's financials, obviously, but also utility hybrids and energy. And the utility space, I mean, with all the AI things that we talked about on this podcast, I think the CapEx needs are going to be there. A lot of it's going to be financed in the preferred market. And usually those calls are 5 or 10 years, but after 10 years, they lose their Moody's rating.
Yeah.
So I think that those are going to be lower duration, 6.5 to 7% coupons, maybe a little through that now. But I think advisors for IRAs, they're not QDI, but I think those make a lot of sense as well. And that whole new issuance, I think, will continue.
Yeah.
But now that's just index eligible. So, in many cases, our ag type buyers ignore the preferred market. Now they can buy hybrid securities that are in indices. And I see retail going to that space as well.
So a couple of quick hits away from markets. This is part of the podcast I always do. Just some little fun, quick hits. I know Kevin pretty well, so I know a few of the things he's interested in. So I'll just ask you, what's your favorite golf course you've ever played?
Ooh. Favorite golf course?
These weren't on the prep call either, so this is just real live stuff here.
Probably Somerset Hills in New Jersey.
Somerset Hills. The greens roll very fast there. Very fast greens. What's your favorite red wine? Kevin is a big, I almost call him the sommelier at credit markets. Just came to me now. But he's a big red wine guy. What's your favorite red wine?
Probably a Left Bank Bordeaux.
Left Bank Bordeaux, old world guy.
Probably one I can't afford. Yeah.
And then finally, as a Notre Dame lacrosse alumni, who's the best college lacrosse player of all time?
It's probably a family. It'd be the Kavanaugh family.
There you go. So that's it. This is OpenYield Markets with Mark. We are so blessed to have Kevin Lynyak on here. Thanks so much for your time today, and signing off from Studio A.
Thank you, Mark.